we're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Bloomberg Quint Live. You're watching Trend Spotting. I am Agam Akil, and in the next 30 minutes, we deep dive into specific trends in the markets to draw out key takeaways and their implications for investors. First, the headlines. Markets gain for the 10th straight day, continuing its longest winning streak in 3 years. Nifty holds up about 10,550, and FMCG and media counters extend support. Broader markets fall in line. Infosys CEO Salil Parekh says it's time to sacrifice margins for growth, highlights need to grow in presence in the Internet of Things segment. And Fortis Healthcare gains almost 2% after receiving a non-binding interest from Chinese conglomerate Fosun International. Electrosteel Steels is locked in a lower circuit after the Kolkata NCLT clears Anil Agarwal's 5,000 crore proposal for the stressed steel company. Let's start by taking a look at how the markets are faring, and well, we are looking at consolidation continuing for the likes of the Nifty and the Sensex, where, as you can see, Nifty and the Sensex advancing by as much as 0.2%. The Nifty Bank, on the other hand, were largely flattish moves. When it comes to the India Volatility Index as well, not too much to speak for, considering we are looking at a further decline, which has now moved below the mark of 14. In terms of the big movers with respect to the Nifty too, we continue to see a lot of traction in, the pharma space, of course, and also the power space. So with respect to the big movers, as far as the Nifty is concerned, or rather the broader markets too, we are looking at more traction in something like a power grid, or for that matter even ITC. There you have it. So those are the top gainers on the Nifty. ITC advancing by as much as 3%, followed by Z Entertainment, also up as much as 2.3%, and Wipro advancing by as much as 1.7%. Yes Bank, Cipla and GAIL among other counters advancing as well. In terms of losers, we do have a little bit of weakness in the likes of something like Hindustan Zinc, and in the broader markets we're looking at further declines in HPCL, HCL Technologies and BPCL. So we continue to see weakness when it comes to some of these oil marketing companies, extending the losses that we saw in the previous week. So let's also take a look at what's trending today. Well, as I was mentioning, we are looking at further advance in the mid-cap IT space. So Hexaware, Mindtree, as well as NIT Technologies extending gains. And we've also seen a lot of pickup with respect to the futures and options space, where we're looking at a substantial increase in open interest towards fresh longs. Don't forget, Mindtree will come out with its earnings later on, post-market hours, about 5 o'clock. And of course, that's what we have in terms of trends today. The other patch that we are looking at in terms of advances is the Indian Hotels. And Indian Hotels company specifically is also moving up, and several other counters also moving and advancing. Let's also take a look at what we have in terms of trend spotting. We take a look at how 5paisa Capital has performed in the March quarter with the Chief Executive Officer Prakarsh Gagdani, and what is the street expecting from the FMCG players. We speak to Kaustubh Pawaskar of Sharekhan, and we tell you all about Vedanta's acquisition of Electrosteel Steels, and we will cover all of that in the next 30 minutes. So let's quickly go across to and put a spotlight on 5paisa Capital. The company's March quarter profits witnessed strong growth despite its loss widening to a little less than 7 crores. Let's, we have with us right now Saloni Dhanuka, who will be joining us, and of course the Chief Executive Officer of the company, Prakarsh Gagdani, to also take us through the quarter and all that we can expect in the quarters to come. So, Saloni, we have you with us. Thanks for joining us. And Prakash, thanks for joining us.
Thank you. Thanks for having me here.
Yeah, so Prakash, I'm just going to start off with a basic question about how you assess this quarter's earnings and, the possible reason behind the widening of the loss figure.
Yeah. So the quarter has been good. So you see around 42% growth we've registered over the previous quarter. So overall, the revenues have been strong and our acquisition engine is going good. So on an overall basis, the growth looks to be stronger, and the same looks to continue for the next quarter. As far as the cost is concerned, if you see that our revenues have grown around 42%, but our cost has not gone up more than 10-15%. So though we are in a growing phase, and that leads to building up the cost, but on an overall basis, the cost per customer or the cost per unit is going down quarter on quarter. Though in terms of absolute numbers, they see a marginal rise, but on a per unit basis, obviously that is reducing.
Okay.
So despite a sharp run-up in your top line, as he mentioned, net losses have actually widened to 25 crore for FY18, for the financial year 2018. Yeah. What has been the reason for that, and when will you see a turnaround in that bottom line, basically?
See, Saloni, what happens is that we're just a 2-year-old company, so markets are dynamic. So there's a lot of cost which goes into building up business, and especially we into digital space and a new entrant. So there are a lot of things that we have to build on the technology, on the marketing front, and building up the team. So this is the time that we are building up our infrastructure, we're building up our technology and people, and also spending on the marketing activity. So that has gone into the cost that you see, which is widened, to a loss of 25 crores. But I think this is a building block. So from here on, what you see is not exponential rise in terms of the cost, but obviously good growth in terms of the top line. And just to answer your question in terms of where that will, so it's difficult to say that where that will break even, because in digital space, what we are actually looking for is how do we get more and more customers in a shorter possible time. So that takes a toll on the profitability.
Prakash, speaking of customer acquisition, this space is not devoid of competition, and we know of several other players also coming in, putting as much if not more in terms of investments. How are you dealing with this, and how are you differentiating yourself with respect to business?
I agree with you that there is a competition, but if you see our growth, I was here last time when our company got listed in November, and we were at around 25-26,000 customer base. We are already, as we speak, we are at 75,000 customer base, so we have tripled in last 5 months. So the growth in terms of customer acquisition has been good. And with the indicators that I get, that we are catching up in terms of the numbers as compared to all the big players. Right. So though there is a competition, we're growing past our competitors, and we're coming in the top 10, top 15 players in the league. So it means that somewhere people are liking our offering. We just charge 10 rupees per order, which is the lowest in the industry, and it's almost 98-99% cheaper. So that's the value proposition, plus the overall experience of our mobile app and overall trading has been very good. So I think that gives us a confidence that people are liking our product and they're lapping it to it.
Would you suggest that the market is large enough and that it is not as saturated enough for all you and your competitors to grow?
I think, though this has been spoken a lot, that our demat penetration is very less and there is a lot of room. But if you actually see in last 12-18 months, the kind of revolution which has happened in terms of internet penetration, people going on the data, the cost which is going down, that has seen a huge demand for people getting into financial products, and that we are seeing. Right. So we have, we are having almost like more than 2.5-3 crore demat accounts, already open and almost a 15 to 16% growth in the demat accounts. That's healthy. So, and I don't see a reason why it would slow down. So I think we are at the at the bottom of the pyramid, and there's a long way to go.
Right.
Since you're working in a very highly competitive industry, how do you plan to increase your market share? I believe it is somewhere around 1% of the daily cash turnover on the BSE and NSE. So what kind of strategy are you working with?
See, we are an online player, so we are not into advisory. So per se, we don't control or we don't recommend people to trade more. But if you've seen our turnover, we already clock around 6,000 crore of turnover on a daily basis. And on a cash market, we are at 1% market share. So that has been growing. We were like, what, 3,000 crore of turnover just for a few months back. And it's 100% growth. So, so overall, our turnover and our retail participation has been growing, and that's helping us increase our turnover.
Right.
And what about business beyond equities? How do you see insurance or for that matter mutual fund as a product? Do you see some kind of traction there?
Mutual fund business for us is our key business, and we feel that and we encourage people more to go for mutual funds and a sustained way of investing. So, so there we have seen a good traction. Our book has grown almost 100% in last quarter in terms of SIPs are concerned. We are already at 35-36 crores of AUM, which is less, but the growth has been good. So mutual fund as a business is something that we are really looking for, and we are really investing a lot in terms of advising our customers, robo advisory. So that's something that we look forward for. Apart from mutual funds, we are now adding a lot of other products, like health insurance, life insurance, and other insurance products. We were also offering personal loans to our customer. So basically, any product which can be digitally fulfilled is something that we are looking for and we're working on.
All right. In terms of insurance that you mentioned, have you filed with IRDA that you will be launching these products, and what is the timeline that you're working with?
So we are applying for a corporate agency and going with IRDA right now. So we are in the process of that. Once we're there, then we'll soon start all our insurance.
And my last question to you will be, what kind of customer acquisition target are you working for FY19? Since you said it is currently around 75,000 for as of now. So what kind of target are you working with?
See, the targets, market surprises are with us with the targets. So, we plan to do around 50,000 customers this year, and we've overpassed that by almost 50%. So this year also we look for getting around 150,000 to 200,000 customers more. But I think markets and people will definitely surprise us.
Right, but and I'm not asking you for a guidance or anything else, but can you give us an idea of the kind of numbers that you're working with right now with respect to at least the top line?
It would be difficult actually for me to give numbers, because it all depends on how the market behaves. For example, last quarter has been not that great on the markets. Markets are down, so it is difficult to predict the numbers per se. But I think the growth would be healthy, looking at the customer acquisition that we're doing.
Okay. Well, fair enough, Prakash. Thanks for joining us and giving us an update on the quarter's earnings.
My pleasure.
And Saloni, thank you as well for taking us to the earnings. But that said, we'll move on, and we'll move on to another space which is consumption related. In fact, a little more focused on consumption, and that is FMCG. In the past 1 week or so, what we've really seen is a lot of analysts and brokerages coming out with reports on several other stocks, and they've suggested that a lot of these stocks have a lot of potential to grow on the back of premiumization and growing product line. But there are also questions with respect to, well, the valuations, and we all know while the FMCG companies have always traded at premium valuations, at some point in time, there are some broking houses which are willing to at least say that at this point in time, they want to take a breather before they initiate more long positions in a lot of these FMCG companies. Let's take a look at how some of these stocks have done. So let's consider something like an ITC versus an HUL, and while there is a differentiated play, and considering ITC still gets a majority of its revenues from cigarettes, still, as you can see, HUL has skipped ITC by just a bit of a margin. But let's not forget that ITC has gained a lot more. Let's pull up something like a Nestle and Britannia, and both these counters again have been focusing on becoming an all foods company. And again, while we have seen divergent trends coming here, as you can see, the price to earnings estimates there as well, we are looking at, well, largely an up move, but and of course we haven't seen too much of a difference with respect to some of these counters, at least over the last few months. Let's also get in an analyst perspective here. So we do have Kaustubh Pawaskar of Sharekhan joining us to give us an idea of how valuations are set for now when it comes to the FMCG sector, and also perhaps to give us an idea of, well, the fourth quarter that's gone by. Kaustubh, good morning and thanks for joining us. Let me just begin with what you make of the valuations of the large 4 or 5 companies that you are focused on, and you know, how you would go about trading, or you wouldn't worry much about valuations and you would still insist on holding these stocks considering that they were long-term plays.
Yeah, so valuation per se, if you see, I think most of the companies are trading at a premium, but you know, I wouldn't mind you know, investors holding the stocks, because obviously the growth prospect of FMCG companies are improving, and we expect, you know, FY 2019 to be much better than what the earlier years. And I think with IMD giving some positive you know, estimates in terms of you know, third consecutive quarter of better monsoon, and if you know, monsoon pan out well, I think that would further drive the consumption in the rural market. So we should see FY 2019 to be much better in terms of consumption, both in urban and rural market. Will not have any one-offs like demonetization or GST, because I think trade channels are now almost stabilized. So I think FY 2019 should be better than what it was in terms of FY 2018 and 17. So in terms of consumption, we should expect a better volume growth in 2019, and the margins are expected to be better, considering the fact that except for crude derivatives and oils, I think other raw material prices have stabilized. So in terms of margins also, we should see better numbers for FMCG companies. So I believe that one should hold on from the longer term view.
Okay, Kaustubh, so let's talk about the fourth quarter, and I want to understand what the impact of a normalizing of your base you know, plays when it comes to volumes, because you just spoke about volumes growth, and you know, the impact of demonetization will no longer show up. So I'm assuming that whatever growth there will be will mean a genuine uptick in demand. Please correct me if I'm wrong there, and also if you can give me an understanding of how you see volumes develop from here on, and what that will mean for the quarterly earnings for the fourth quarter gone by.
Right. So in fourth quarter, we would see, you know, volume growth, you know, in the range of 8 to 10% for large companies. Also, we need to understand that demonetization lag effect was there in Q4 as well. So obviously, in base there would be some impact of demonetization, but it would not be in the range what it was in third quarter. But also in Q4, the trade channels have improved, you know, post the GST impact. So obviously, in terms of primary consumption, in terms of base, I believe that Q4 we would see, you know, much better in terms of volume growth compared to Q3. However, on sequential basis, I believe that it would be more or less same. But on YY basis, obviously there would be much better improvement in terms of volume growth in Q4.
Okay, Kaustubh, then let's talk about you know, stocks specifically, and if I'm not mistaken, you do not prefer or you do not expect ITC, Emami and Marico to do as well as the other players in the sector?
See, ITC, obviously because of the price increases what the company has taken and the increase in the taxes, I think that will have an impact on the volumes. So we are not expecting, you know, cigarette business to do well. However, on the other hand, non-cigarette FMCG business would definitely clock good growth. But cigarettes still contributing about 60-65% of its revenues. I don't expect it to, ITC to post good growth in Q4. For Emami, obviously the growth excluding Kesh King would be much better, but including Kesh King, since the distribution and the brand restructuring is in post, I think that will affect the overall revenue growth of Emami. Also in terms of margin, still since Mentha prices have gone up substantially, I think that will have impact on the margins of the Emami in the Q4. So on the like-to-like basis, the growth would be better in terms of revenues. However, at the operating front, since margins are expected to impact because of the increase in the raw material prices, I think operating profit should be flat, or there should be marginal decrease in operating profit for Emami.
But yeah, please go on. Okay, so then I'm going to follow that up with your positive stance on something like an HUL, or for that matter Britannia Industries, at least with respect to quarterly earnings.
HUL obviously because whatever pricing action company took post the implementation of GST and the reduction in the tax rate in the month of November, I think those pricing action would definitely bode well for the company, and we will see good numbers in Q4 in some of the key categories for HUL. So I believe that volume growth for HUL should be in the range of 8 to 9% in Q4. Also the palm oil prices and other key input prices have remained benign in Q4. So in terms of margins also, we should expect better margins for HUL on YoY basis. So overall, I think double-digit earning growth should be there for HUL. Britannia, obviously the company has been doing good. I think post the stabilization of trade channels, and company is penetrating in the regional markets. So I think post the stabilization of trade channels, I think company should do well in the regional markets, and that will help it to achieve good volume growth in Q4. Also the raw material prices have remained benign for Britannia, so I think that will help margins to be better on YoY basis. So I think Britannia and HUL should score well in Q4.
So just a word on raw material costs, because I was going through some numbers and I'm looking at, well, should I say mixed trends with respect to input costs, not only on the last 3-month basis, but also if you look at year on year. Do you think that this is going to have a substantial impact on margins for this particular quarter?
See, I think oil companies or hair oil companies would have an impact, because copra prices are still high on YoY basis. Also, along with copra, the LLP and other key input prices have gone up. So I think for Marico, we will see substantial impact on the margins. Though they have taken the price increases, I think the impact would be there on the margins in Q4. As I said, Emami, because of the rising Mentha prices and LLP and other key input prices, I think there will see the impact on the prices. So companies who are specifically into hair oil, and value-added hair oil, I think they will see impact on the margins. But I think rest of the basket should do well in terms of the margin. Also, we might see lower margins for paint companies, since the crude derivative prices have started seeing an uptake. I think they might see a decline in the margin. So barring for paint and the hair oil companies, I think other FMCG baskets should do well in terms of margins.
Okay, Kaustubh, we'll leave it at that. Thanks for joining us and giving us an update on the sector and also what we can expect from the fourth quarter. But moving on, Electrosteel Steels will soon be a Vedanta Group company. The Kolkata NCLT cleared Anil Agarwal's 5,000 crore proposal for the stressed steel company. Electrosteel was one among the first 12 large corporate accounts bought under the Insolvency and Bankruptcy Code. While the lenders will still have to take a haircut, we have Nikki Mirchandani who's done the math on whether the deal makes sense for Vedanta. Nikki, over to you.
Thank you, Agam. Yes, definitely it's a steel deal for Vedanta. Looking at the valuation, it's a value accretive. It's not expected to weigh on the balance sheet of the company. First things first, let's look at how the deal has been structured. Overall, Vedanta is expected to pay as much as 5,320 crore to all its debtors. Now, this will be done in two bits, which is the equity and the debt. For debt portion, which forms 34% of your overall holding, the company will have to pay in 1,805 crore to its existing for subscription of a share capital, and then it will have to pay another 3,515 crore. This will be for by the way of debt for Electrosteel, but then all of it will actually go towards the payment of debtors. In the second bit, let's understand the kind of shareholding pattern which will change post the acquisition happens. Currently, promoter shareholdings for Electrosteel stands at 45.23%, while the public stands at roughly 55%. Post acquisition, this will change with Vedanta subsidiary holding as much as 90%, while the 10% stake will still remain with the existing or the minority shareholders of the company. What Electrosteel has for Vedanta? Well, the current capacity is around 1.5 MTPA, but then the overall capacity is actually 2.5 MTPA, which means that Vedanta will have to put up some kind of capex in order to ramp up the capacity to 2.5 MTPA, which means a capacity ramp up of nearly 1 MTPA. Now, if you look at what is in it for Vedanta in terms of the 2.5 MTPA, these are the assets that we're looking at. Wire rods, you would see 0.6 MTPA. For TMT bar, it's 0.8. Ductile 0.3, billets 0.33, and the pig iron is 0.4. That's a composition of 2.5 MTPA.
Right, fair enough, but does this make for a good deal for Vedanta, Nikki?
Sure. I mean, as I just mentioned, it's a steel deal for Vedanta, Agam. But I'm going to point out to the assumptions before we could get into the math. EBITDA per ton for the industry is implied at 7,500. EV to EBITDA of industry is assumed at a standard of 6 times, debt to EBITDA at 3 times.
Okay, Nikki, thanks for joining us and giving us an update on that particular development within the metal space. We'll continue to track more developments on Vedanta as well as Electrosteel Steels. But with that, it's a wrap on this edition of Trendspotting. But don't go anywhere. Up next is Hot Money, so stay tuned in a Bloomberg Quint Live.